stream today. My name is Micah Blanc. I help people become financially free with real estate. And one of the questions I get a lot is, hey, what's going on with the market right now? Is it, are prices going up? Are they going down? What about interest rates? What about this recession we keep hearing about? So I want to talk about all that, about the state of multifamily. So let's get into it right now here. I got a couple slides prepared for you guys. So first of all, there's a few factors involved here. One of them is increasing demand for housing and a housing shortage. So this is a recent article in Business Insider. Two reasons in the U.S. is a major housing shortage, and it's because, number one, you can't build affordable housing. Okay, due to inflation, supply chain issues, it's gotten so expensive to build new housing, including apartment buildings, that they're not making more apartment units. And all of this is really putting a crunch on the entire housing market. It's driving up the prices of single family houses. That in turn then is pricing some people out of the housing market, which is pushing them into rentals. And so this is great for us, but the point is we have a major housing shortage. CNBC thinks that we have 5 million homes that need to be built. And right now we have the lowest housing permits ever issued in like 30 years. So, and it's because it's so expensive to build and no one wants to show up for work. And so builders are like, you know what, it's no longer profitable for me and I'm not even going to pull a permit anymore. So this is a major problem, for affordable housing in general, but it's great for rentals. The other thing that's driving rents up is inflation. Okay, so this is the recent inflation chart, and people thought, oh, the Fed was like, back in January, oh, inflation is transitory. Well, clearly not. It was down in April and then spiked to the highest level in May. And if you look at the news right now, they're like, oh, inflation has peaked. Why? Why would inflation have peaked? There's nothing driving it down. Fed is raising interest rates, but it's so little, it's not doing anything. The supply chain issues aren't going away. People are still getting government subsidies and programs and still not showing up for work. So why would inflation go down? I don't think it's going to go at all, but we have high inflation. That's driving up rents. Now, here's why we love inflation, okay? Because inflation drives up expenses, but also income in parallel, okay? Like this line indicates. And of course, because there's a gap between income and expenses, it drives up NOI also. And as you know, as NOI goes up, so do the prices of the commercial real estate. So this is why increasing rents is driving up prices. Our portfolio in the last 12 months probably went up by like 40%. And that's because rents went up by like 20%. It's unbelievable. You look at this, this is from rent.com. You can see that nationwide, the past 12 months, rents have been up 25%. That is a staggering amount. Meanwhile, the Fed is saying that the inflation rate is up by 8.6, which we know is horse manure because they exclude housing and energy and food from this index, which is ridiculous. Those are went up the most. So rents have gone up by a lot, but it's not created equal. You look on the left here, and some cities have increased between 40 and 70%, but then there's others who have actually gone down, right? So real estate is still local. So while in general rents have been driven up by housing demand and inflation, it's still kind of a regional local game, which we all know. Now, interestingly, we talk about an affordability issue. Okay, how much further can rents go up? And I think they can go up quite a bit because as inflation goes up, incomes also go up. Now, they don't go up at the same pace, which means that people are effectively making slightly less money, but they're still growing. And this is why people are still affording the rents. They need a place to live. They may have curbed some of their other expenses, like you saw some layoff in Netflix and some of the retailers. People maybe are buying less, but they still need housing, right? And they're not going to want to sleep under the bridge, so they're going to afford the most they can, and that is rental housing. So incomes are still going up. Now let's talk about the rising interest rates. So we have these rising rents, and it has created massive opportunity for people in the multifamily space. And now interest rates are rising. We all know this. And what that's doing is it's normalizing the gap again. Okay, we have this giant gap through rising interest rates. Interest rates stayed flat, rents are going up, giant gap. People just plowed into multifamily. Okay, well, rising interest rates are going to start to close that gap and normalize the gap. This is nothing to be afraid of. In fact, this is what it was 18 months ago. And so it's just normalizing that gap. Well, let's look at the interest rates here. So here's an article from just a little while ago, actually June 15th, and where the Fed, of course, increased by 3/4 of a point. It's the biggest rate hike. What does it mean to you? Okay. So basically, the Fed raised the rates from 0 to 1.5. It was 0 the longest time since COVID and then after the last recession. And now they raise it to 1.5, and they want to go to high as 3.25 and at the end of the year, which of course is double what it is now and seems really scary. But if you look at the history of it all, okay, here's where we are right now, the few recent years. You can see here where it was before COVID. It was at a rate of about 2.5%. They're forecasting that we might be able to get up to that and a little bit higher. Not a big deal, really. But if you look at the average since 1971, the average interest rate has been just under 8%. We're still far below that, even though to us, it seems like this giant shock and trauma. To some degree, it is a little bit shock and trauma because it's happening so quickly. But from an historic perspective, it is super, super affordable. Look at how it goes back for the last 25 years, and look at the spike right before the recession. Right, we're up to 6% and then 5%, and then the recession happened and rates were cut down. And same thing for COVID. As soon as COVID hit, rates went right back down to 0. But look at the years 2016 to 2019. Right, look how high it was, around 3%, which is where the Fed is threatening to go. We were all happily buying multifamily. In fact, millions have been made during this time, and we're kind of headed back there. It's really not a big deal. As far as I'm concerned, it's just something that you factor into your underwriting. But here's what I'm saying is threatening. I don't think the Fed is going anywhere over 3%. And the reason is because of our debt. We have $30 trillion in debt. And if the Fed gets to 3%, which would be going to where it was before COVID. If they go back to that, you can see here that the debt service, the interest, is bigger than Medicaid, Medicare, all defense spending, okay, and Social Security retirement. In other words, it's so expensive the higher the rates go that it'll be the single biggest expense, and it's going to be problematic for us to service our own debt. So I think there's going to be a limit to how high the Fed will go. In fact, I think what the Fed will do is if they raise rates and it creates a recession, they will probably lower interest rates again to save the economy from itself, therefore, again, fueling inflation. So what am I saying here? I'm thinking why prices are going to keep going up is because we have continued high demand and limited supply. We have high inflation. We have rising incomes, and that's going to drive rents up. Okay. Now we have relatively low interest rates. Therefore, the prices are going up. In other words, interest rates are not going up at the same rate inflation. Inflation is much higher than interest rates are. And the way that you're going to address that is simply when you're underwriting, right? Okay, if the rates are going up, and right now we're getting commercial real estate loans right around 5%, they might go up. You might use underwriting for 7% when you refinance or even sell, right? And so it's something you simply factor into your underwriting. But bottom line is this, guys. I think we are in the biggest wealth creation opportunity of a lifetime because we are in an inflationary environment. And I think that's really the bottom line. Interest rates are going up, but they're not going up nearly as much as inflation is. And in my opinion, they're not going up anywhere near to do anything about inflation. If you look at the early 80s, for example, inflation was right around where it is now, and interest rates were at 16% before they came down. We're at like 1.5%. Okay, we're nowhere near. So interest rates are going up, but not nearly as much inflation. We are in an inflationary environment, and that is really good for real estate. So there you guys, you have it. I'm very bullish on it. Again, always you're cautious. Now we do probably have likely having a recession coming in. How do you deal with that? Well, you deal with that simply by factoring in a little bit more turnover than normally, right? So in vacancy, if you have higher turnover, so if people do get laid off, and they can't afford, $1,400 a rent in a Class B asset, well, they can afford $1,000 a month. They're going to go in a cheaper asset, and so they're going to leave your unit and move somewhere else. Meanwhile, people who can't afford houses are going to move into your units, and that's going to create some unwanted turnover. So instead of maybe projecting 90% occupancy rate, maybe you project 85 or even 80, just to be a little more conservative. So you deal some of these things with your underwriting, but the point is there's going to be some opportunity. There's currently more sellers than buyers out there. There's going to be opportunity. And I think in the medium term, it's going to be fantastic for real estate. So there we are, Anna. That's my outlook on multifamily for the next 12 to 18 months.
Thank you so much, Michael. That was very relevant, very helpful. We have had so many people just asking these questions, so we really appreciate your time today. Everyone, please check the Facebook group for our free resource that is going out today. Please reach out to an admin. We have actual dealmaker guides ready to talk to you. You can schedule a free call with them and talk about exactly what Michael was just discussing and really plan out your next 12 to 18 months. So thank you, Michael, and we will all talk soon. Bye.